Broadcasting from the commodity capital of the world, Zurich, Switzerland, this is Insider's Guide to Energy.
This edition to Insider's Guide to Energy is brought to you by Fidectis. Go to www.fidectis.com for more information.
Welcome to Insider's Guide to Energy. I'm your host, Chris Sass, and with me, as always, is Jeff. Jeff, welcome back to the program.
This is great, Chris. Really a pleasure to guest host episode number 3 for both of us.
Yeah, it is a pleasure to have you here. I think we're getting into the swing of things. What I'm excited about is the topics we're covering, right? I mean, today we're going to go into microgrids. This is right in the wheelhouse of the kind of things that I want to talk about. So why don't you tell us what we're going to do?
Yeah, today it's a real pleasure. We've got Julian Torres, the Chief Investment Officer of Scale Microgrid Solutions. SMS is a national leader in the deployment financing of commercial microgrids. We're going to learn a lot more about that today. Julian, welcome. Thanks for joining us on the show.
Thanks, Jeff. Thanks, Chris. Happy to be here.
So start us off. I know microgrid is a term that gets thrown around a lot, and most people probably think they know what it is, but there are some maybe differing definitions. Help us orient at the top here. How do you think about what a microgrid is and why it's important?
I think the taxonomy is very self-serving, depending on who's defining it, but I'll give you my definition. And that definition is, it's first and foremost a distributed energy resource. So, it's behind the meter. It's a combination of varying types of generation types and storage. So technologies such as solar, batteries, dispatchable generation such as a reciprocating gas-fired engine, CHP, a fuel cell, or some other type of long duration storage that can be called upon demand, all behind a microgrid controller that can be optimizing the output based on the available resource, based on market conditions, even in terms of the cost of those inputs and certain parameters that maybe a customer might influence. And the really defining component of all of that together is that it's islandable. So it's capable of running in parallel with the grid during normal operations. But when the grid is out, the microgrid's defining characteristic is that all of these assets working together as a single unit create an island for the facility. So that's
this is really
the most important component to a microgrid.
Yeah, and I'm glad you mentioned that, because I think that one of the widely held misconceptions around solar installations is that it will provide backup power. Unfortunately, a lot of systems that are out there, if they don't have an automated transfer switch, the grid goes out, the solar goes out. And so what you're talking about is the grid goes down and actually, the solar can keep powering it, but it needs some other components. It needs storage, it needs the right switchgear, it needs the right controller, and maybe some sort of other thermal backbone. Is that right?
There's a tremendous amount of electrical engineering that goes into integrating these systems. Thankfully, we pride ourselves in making it easy for microgrids to be deployed. And our value proposition, we broadly think there are 3 main axes for the systems, for microgrid systems. You can have lower carbon from your system. You can have dispatchability from your system, or resiliency, or you can have a system that is more cost effective than what's available at the grid. And sometimes in some markets, those 3 axes can be in a corner, if you will, where Chris, you want to jump in?
No, finish
Of
your thought.
where you get the optimal, where you get low carbon solution, you get long duration, and you can save money at the same time. In some instances, maybe you're paying a premium for resiliency if the subsidies aren't as strong. It really all depends. And I think a good microgrid company can basically do a techno-economic optimization process with a customer to figure out what are the important attributes that you want to basically emphasize in the system. And then a good company can also curate the right components that work together so that these transfers from grid to parallel are as seamless as possible.
I guess the question that comes to mind as you're describing this, I get the island nature in this. Is what's the economy? The U is that a large enterprise? Is that housing development? Is it an individual home? Like who are the you that these microgrids are helping get this energy from?
It can vary substantially in our approach to microgrids, and there are some microgrids that are capable of supporting single family homes. Generally, though, we see them, the primary use case is commercial and industrial customers. Lots of different segments are natural host customers for a microgrid. Examples can include cold storage facilities, distribution and logistics centers, particularly those that are going to adopt electric vehicles as their fleet and move away from internal combustion based fleets. Other end uses can be as expansive as college campuses, data centers. There's I like to say everyone needs a microgrid, and it's like kind of true. Um, but they really are varied, and that's what's great about a microgrid in the context of how it's defined in terms of having multiple asset types, because really you're matching the asset types to the resource, to the footprint, to the type of facility. Some facilities might have a thermal need, so a CHP component is more valuable. Some may not, so that's not something you'd add to the mix. Sometimes you just need a standby generator to provide that to be more of a backup power source rather than being contributing to like the base electrical or thermal needs of a host facility.
Yeah. Which sounds like a double-edged sword, right? The benefit is that it can, part of the reason it's hard to define a microgrid is because it isn't one size fits all. We're not talking about a cookie cutter, residential solar installation. It can be fluid to match the needs of the customer, but at the same time, that means there's a lot of complexity. That complexity sounds like one of the biggest challenges for microgrid deployments to be efficient in that customer conversation. And then I imagine that has knock-on effects into the financing. So what do you see as the biggest challenges for the adoption of microgrids? Is it in that complexity, or what are the biggest barriers to adoption?
I think the challenges that microgrids face as a growth technology are similar to challenges that other distributed technologies have faced over the course of their deployment, their arc, going from early adopter to mainstream. And I'm not a technologist. I'm looking at this in the lens generally as a financier and someone who is generally looking at offering a sort of finance solution. And generally, those are based on commercialized products. And so we feel that microgrids in many instances are very much commercialized. In some instances, they could be bleeding edge in terms of technology. So certainly having market awareness is a big challenge. And I think what people didn't realize 10 years ago about solar in terms of market awareness, in terms of like how cost effective it can be. Certainly you touched on some of the technical limitations earlier in this session here about what a straight solar can and can't do. But there's awareness of the product. There's certainly a lack of scale. I think we're still measuring the scope of the marketplace in hundreds of megawatts. I think we're on the cusp of getting to sort of gigawatts annually deployed of microgrids. Again, depends on how you define it, what you allow under the tent of that definition. But awareness of the customer, scale, and I think standardization, again, potentially related to how you define it. And I think we're the earlier stage of the ecosystem of OEMs and vendors bringing competing products to market. I think there's a hopefully a growth of service offerings, technology solutions, and so forth that take this to that sort of next level.
Now, with that complexity, is there a price point in the market that's driving this today? Because I mean, a lot of the technology, I mean, the storage is definitely improving dramatically, but is it a function of cost then? So I mean, obviously you can do peak shaving, you can do all kinds of things if you have it, but does this only work at a certain price point, or do people want it no matter what because of discontinuity in the grid and they're afraid of outages? Like, why are companies doing this today?
There are a number of key drivers. One of the biggest drivers right now is the inability to have a utility deliver new service or upgraded service to a location. That's generally been a consistent theme across the last couple of years, with customers coming to us. They want to expand a facility. Maybe they took over and repurposed a facility that has already existed, has a legacy load profile not matching the go forward business use case of that facility. And they're hearing that interconnecting electricity with the grid is going to cost a tremendous amount. It's uncertain as to the timing, and maybe there's also risk around the cost. And so what we can do, what a microgrid can do, is provide that sort of around the clock power solution, mitigate the need to upgrade that interconnection, and provide price certainty for the duration of a long-term contract if the customer wants a long-term contract. And so it really ties everything up in a nice bow. And you could look at different segments, and different things are catalysts for that microgrid thing. And happy to dive into that if we have time. But it's really, first and foremost, there's a congested grid. There's a massive demand for expanding, commercial and industrial facilities, and an inability to meet that demand without a microgrid.
That's really interesting. So, adding to your list of decarbonization, dispatch, like resiliency, and carbon cost effectiveness. Sorry, carbon dispatchability and cost effectiveness. You've also got just literally the size of the pipe, so to speak, coming to that building. And so, maybe to use a data analogy, you've got a dial-up modem. That's your connection to the grid. You call the utility to say, well, we can't expand that pipe. It's going to take us 2 years, or we can't give you a timeline. You are the dropping from the sky, 100 gigabit satellite connection that enables that site to now massively go beyond the limitations of their current hardwire connection to the grid. That's really interesting, and I haven't really heard that before, and it sounds like that's one of the biggest drivers for microgrids.
Now, for mission critical infrastructure, there's a use case for microgrids and having a specific duration of resiliency that is also a big driver of our product. But I think the ability to overcome such an obstacle with a product of time and money is like definitely a primary, like an order one
Mm-hmm.
sort of driver.
Yeah.
Everything else
So
is like sort of like a cost benefit type of play of, you know, what's my insurance? Like, it's kind of like, you can also view microgrids as sort of like an insurance product. If you're going down the resiliency path, you kind of are thinking about it in that sense. And that's more of like a premium. Whereas, the other driver is more of like removing an obstacle.
Yeah. Well, I like thinking about things as insurance products. But so going back to your
Tell us more,
background,
Jeff.
going back to you, Julian, right? Like, this is a really interesting problem. We're talking a lot about the technology, but one of the key things you mentioned was standardization and really the financeability of microgrids. So talk to us a little bit about your background, how you came to the challenge, and where your perspective fits into advancing the industry.
Sure. Well, I came into the microgrid space following a multi-decades long career in structured finance. The last dozen years or so, really in the weeds of tax credit monetization and project financing of distributed assets, utility scale assets, all points in between, as a banker, an advisor, an investor. And really, I recognize that there's like a gap in at least in the U.S. market between the utility scale, the residential scale, the C&I market, and meeting that gap in the C&I market is a lack of value add. And so with the current role, adding value is a technological process. It's also a financial process. Being able to take that upfront capex, break it down into units that essentially over a 20-year period can be absorbed, through that value stack of the rate base, essentially, is, or being an alternative to the rate base, is a very powerful value proposition ultimately. And so we're leveraging the same tax credit, Section 48 ITC. We're leveraging a lot of the same concepts around risk allocation in long-term contracts with host customers. So really and truly, it looks and feel like something you've done before if you're entering into a financing contract with us.
This is great. I like to say finance is fuel in renewables because it's all about LCOE. That means spreading out upfront capital costs over a longer period of time, which means it's all about the structuring and financing. Also, I love that you mentioned tax credits. I feel like that's a great topic because half of the audience instantly falls asleep and the other half actually perks up. You say C&I tax credits and half the audience is like, okay, I'm listening. This is really important. Just want to say this is also a changing environment. Anything you want to mention just quickly post IRA on the tax credit landscape as it relates to C&I?
Definitely a transitional period. And the last time we had such a transitional period was, I think, when the American Reinvestment and Recovery Act created a concept called a cash grant in lieu of a tax credit. And that created some financial innovation, but it was essentially temporary. The IRA brings to the table two new vehicles for monetizing tax credits, either direct pay if you're a qualifying tax exempt entity, or direct transfer, which heretofore for federal tax credits was essentially banned by Congress. So you could not sell tax credits. You always had to, whether it was a tax credit for a manufacturing facility or some aircraft. And tax credits have been with us a lot longer than 1992. The first tax credits actually were created in the early 60s to give American manufacturers an edge competing with post-war European manufacturers that could have a labor cost advantage. And leasing partnerships, all of these crazy financial structures evolved over decades and decades, and following twists and turns in policy. So we're in a transitionary period where now you can sell these tax credits. There are state tax credits that are proxies for how these markets might function. People are looking at those. We're waiting on guidance that will give us a lot of the much needed clarity to create more product and standardization around the approach. But it's very, very exciting because there's, as you can imagine, there's always a universe of buyers out there in a marketplace, a universe of sellers with needs and wants that sometimes match up perfectly, sometimes they don't. Previously that was expressed with some investors want to do a sale leaseback, some want to do a partnership. There are different flavors of partnership. Now we have this option where we can sell a credit and potentially have a much simpler capital stack for those of you that follow this stuff on a regular basis. Integrating debt and tax equity has been a dark art that's been a big friction, a big source of friction over the last probably 5 or 6 years. And I feel like the markets kind of got to a point where they kind of knew how to do it pretty efficiently, but there's a limit to how much capital is available that knows how to do these things, right?
Mm-hmm.
And so I think when you break things into their more fundamental components, which is like, okay, a tax credit's really worth something to someone who wants to pay money for it. That is pretty powerful. So now you can have people who be very passively involved in these technologies and support the growth of this industry and not have to be like, basically shoehorned into something they don't really want. Like they don't like tax efficient buyers or investors previously did not want long duration exposure to energy assets that are liquid. So you had to do all these crazy things to get them over the line. One of the things was potentially pay them a lot, like give them a high yield. And then they had to wait. They had to sign up and wait for the project to actually get built. Now you can actually build the project and then go to market and monetize those tax credits in a very efficient, passive way. Those investors that like long duration cash flows will continue to invest in a way that gives them the tax attributes and the cash flows, and they provide value to counterparties. So I'm very excited about this. Right now, I'd say we're very much in a transitionary period in the marketplace, and people are figuring out where they want to be.
Yeah.
I'm very excited for 2024 with the belief that a lot of this will be settled.
So are we still at the point where we need tax incentives? So when you talk to renewable people, right, there's the camp that says, well, incentives will eventually go away and the market's going to have some challenge in the future. So all the commercial vehicles you just described and the creative ways to get a deal done, does this remain an important aspect for business going forward? So if you're a large enterprise and you're going to put in a microgrid, is it fundamental to making it work, or is there a point where the economies of scale come down, or the economies of cost come down that a microgrid gets to a point where we don't need incentives? Or is this, do you envision 10 years from now we still need incentives to be doing microgrids?
I think I'm very excited about the runway we have for tax credits. I'm very excited that there is now a microgrid specific component to the new and newly expanded Section 48 investment tax credit. And I would say that as long as there are incentives, tax-based or otherwise, for any one type of generator on the grid, then I think we should see a level playing field of renewables continuing to get a subsidy. Otherwise, it gets borne out in the ratepayer base. And a monopoly, for example, is its own form of subsidy, right? Not a lot of people talk about that, but it's very much a true statement. And I would just add one more thing, which is the the economies of scale express themselves through continued and expanded investment. So the investment tax credit is meant to bring down those unit costs through economies of scale. And at the end of the day, what we're tackling are big issues: grid unreliability and climate change, right? And both of those are externalities on society. And so the spreading that over the tax base in terms of like the source of that subsidy, I think distributes that externality and who bears that cost, I think, in a way that's fair, as probably as fair as you could get.
Mhm. It's interesting, a contrast, especially if you're talking about grid upgrades being distributed on the rate base. This is a way of distributing that resiliency
Yeah.
onto the tax base. And
we don't have a national electric policy, right? So there's no
yeah,
like national rate base to put it through. So like, if you look over the last decade, you had very successful feed-in tariff programs in various markets in Europe that really helped scale these businesses and drive the costs down. I don't think feed-in tariffs would get to the right scale in the United States just based on how our
mhm.
utilities and grid work from a policy and technical sort of framework. Um, so really, you kind of get back to like a federal level, and then tax credits. Everyone loves a tax credit, man. It's like,
Yeah, well, I think if they don't, they should, right? And I liked. Did you have an alternative title, Lord of the Dark Arts of Tax Equity Project Finance? Because it does sound like, you thought microgrids are complicated. Where do you see, tax equity financing? And it seems like that also there's interplay, right? Because the new tax credits also vary by technology. There's different adders in addition to the existing structures. So this really, but it's that intersection that is that makes these projects work. It sounds like great.
and it is. It doesn't have to be a dark art. I think there's a fair bit of transparency in the process. I think what makes it seem so, I guess, obtuse is that um, it's a form of capital that's just not, it's very sector specific, in other words. And I think that's somewhat problematic. I think we saw, I could wax poetic, all day. I don't think we have enough time, but, I think one of the fundamental challenges that yieldcos had was explaining the capital stack to, sort of very average investors.
Mhm.
And analysts tracking, like, so you've got a pipeline of projects, and then you've got to get this tax credit monetized, and then it messes up your earnings, and like we don't understand it. So how do we go from a pipeline to like a PE multiple, right? And
Yeah,
I think that's where, I think the tax credit sale option will start to streamline some of our businesses. Some of our reporting, financial reporting, will get a lot more straightforward. And so people can focus on the fundamentals of the value proposition, and a little bit less so about the capital stack. And I think
yeah,
that'll be exciting. And that's probably something that people aren't really talking about right now, but will be. Um, or hopefully they don't have to talk about it at all. It's just,
yeah.
simpler, easier deal flow.
And more. So, Julian, zooming out a little bit, there's a lot going on in the broader financial world that you're in a unique position to comment on. And one of those major trends is around the rapid rise of interest rates, and then more specifically, the fallout from SVB. And there's some other banks. I don't want to comment on the news because it's moving so quickly. But how are you dealing with the change in interest rates, and then anything specific that you see for renewable energy post SVB?
So there's a lot to comment on. And I think we're lucky that the financial community has really grown with the scope of our industry. Um, and the capital generally has been there. I think the uh, the rate increases are actually unprecedented. And I was thinking about this recently. then it's not really widely commented on, but the rate increase rate is actually it's faster. It's a bit faster than it has been before. But if you look back like 03 to 07, leading up to the financial crisis that lasted from 08 through 09 and saw a number of financial institutions come down. One thing that's different this time around is that debt and the cost of debt, which is directly related to your federal funds rate and spreads thereon, was fully deductible from a tax perspective. The tax code changed in 2017 in a way that limits corporations' ability to deduct interest. So debt is actually, not only is it more expensive because the Fed has increased rates, debt's a lot more expensive because you can't get a tax shelter from it. So that used to, soften the sting of Fed rate rises. You don't have that anymore. So you've dramatically reduced the ability for corporations to get a tax savings on their interest burden. And so that's going to have some fallout in the economy. And, we could all make bets on when the Fed pause is going to happen. And I think what is concerning, for capital intensive industries is there's always a lag between the ability for rate increases to filter through to expectations, to filter through to actual like pass-throughs of cost to end users. I think at the end of the day, the value chain makes its way through to the end user of a good, but there's a delay in that process. It takes time to work its way through. People might have closed financings before rates, were increased, and therefore they have a little advantage until they have to go back to market and reset to current rates. And, so there are some weird things that you'll see. Of course, there are unintended consequences always. I think some of the financial institution collapses that we've seen were predictable, and I think there were people closely monitoring sort of like interest rate sensitivity, and duration is that simple mathematical fact that a bond that has a 10-year duration is going to have a sensitivity of 10 times the change in its yield. So, 1% increase will cause that bond to lose 10% of its value. And if you're levered so highly, like a financial institution has to be, you're going to wipe out that capital very quickly. And so, I think I'm encouraged that the project financing market broadly has some of the largest well-capitalized banks leading it. It's not a market for smaller banks generally because of the overhead required to transact in that way. But there are other markets too, right? I think we'll see the bond markets start to get more and more involved in this sector. We've seen a few securitizations of distributed assets, which is very exciting. Borrowing technology that the residential players used and built up and created some depth in that marketplace. Still nothing compared to the mortgage market in terms of depth, but it's certainly not nothing, and it's another outlet to like move towards like the the asset managers and insurance companies that have long dated asset and liability matching requirements. So like our microgrid contracts are 20-year duration paper. So that's very exciting if you're managing an endowment or a pension plan and you've got, fixed and predictable liabilities. So we're seeing more financial innovation. And I think, tying back to the ability to have a simpler capital stack through direct transfer of tax credits, you're going to see another sort of explosion of financial innovation on the back of that.
So I guess what I'm learning from this conversation today is it's really about the finance, right? It's really, can you structure the deal so that the technology hasn't been the gate? It seems like that the technology is in place, and if you have incentives and have a structure we'll get the assets that are needed, and that's what's taking place today, right? So you're saying that this is kind of taking place, this evolution of distributed energy, and with the tax credits as they go, and that the capital market looks good, that you'd be pretty bullish on and where we go on deployment across, let's say, North America with microgrids. Is that a safe takeaway from our conversation today?
Yeah, I think we're all very bullish on the outlook, and there's so many various confluences of tailwinds. So tax policy, technology, macro sort of things, and structural things, like a grid that is exposed to climate change vis-a-vis fire risk, and the way to prevent that is to turn off the grid. Well, if you turn off the grid and you still want to operate your facility, you need to have an islandable, dispatchable power source.
We had to cover PSPS, of course, at least one mention.
Yes.
For the California. And so what I hear you saying is the project finance lending bench is very deep. So low impact of SVB specific. Interest rates are rising, but maybe not as quickly as tariff rates in California. So even if there's added costs, there's enough added benefit to counterbalance. So that's really exciting. One last question before we wrap, if we have time, which is, Julian, do you even decarbonize, bro? Right?
Every day.
So I couldn't believe this headline, but we'll put this in the show notes. New York Times article featuring one of your colleagues. So this is a movement, Julian. Are you a decarb bro? How do you think of yourself and your colleagues as part of this movement?
Well, I think we are certainly, as a group, motivated in a single purpose. Our vision is, as a company, if I can make the pitch, is to power the world with dispatchable assets. Actually, I have to say that again. Can I do it again?
Yeah, sure.
Our vision is to power the world with distributed energy. So that, I think, a big part of distributed energy is low carbon solutions that are based on solar, high efficiency CHP systems, batteries, and that enable further decarbonization, because we didn't touch on this, but they're cornerstones of the electrification of everything movement. And so you'd probably say, hey, bro, do you even decarbonize? Are you fully electrified? You take that a next level further.
Nice.
The memes will proliferate from here. Well,
no
Julian,
shortage of memes.
This is really exciting. We covered a lot of ground, and I think highlighting the complexity, but the essential nature of renewable energy and microgrid project finance. I can't think of anybody better than you to help us navigate through the ins and outs of all of that complexity. So really appreciate the time today. This was a fascinating conversation.
Well, thank you both for having me this afternoon.
Thanks again, Julian. For our audience, we hope you've enjoyed this content. For me, it was eye-opening learning about the project finance. I really didn't have as much clue as I probably should have, and it really did shed a lot of light. If you like this content, you want to see more of this content, please subscribe, follow us. Don't forget to find us on YouTube, and we'll see you again next time. Bye-bye.